Alibaba made its blockbuster debut on the New York Stock Exchange on September 18th at $68 a share. Thanks to the high demand for shares, underwriters exercised an option to sell an additional 48 million of them. All the numbers mean that Alibaba raked in $25 billion in its public offering, beating the previous record held by the Chinese banking behemoth, the Agricultural Bank of China. In the 3 months since then, Alibaba's shares have been a bit volatile at times. They hit a low in mid-October and rose again, hitting a high on November 10th, when shares closed at over $119, the day of Alibaba's super sales for China's Singles' Day shopping spree.
Alibaba is safe from hostile takeover from people like PEs, plus the scale of the company is so big. The factors that might possibly impact Alibaba's share price would be actions by its large shareholders, say if SoftBank or Yahoo sold their holdings. After the November 11th promotions, the price went back down. It seemed like people can predict the exact trend of Alibaba's share prices.
November 11 became an online shopping festival at Alibaba in 2009. This year, the company reported more than 571 billion yuan in sales on the day, compared to just 362 billion yuan during last year's festival. Alibaba followed up its online success with a new idea this year, combining online with offline business with a sale on December 12 that encouraged the use of its financing site Alipay.
For example, NGS Supermarket has teamed up with Alipay to offer big discounts at their stores, and taxi passengers were exempt from the initial flag drop fare if they paid via their Alipay wallet. Starting from December 12th, a new consumer culture was born, and it's led by a traditional internet company.
But the internet is not just about selling things, it's also about people connecting with each other via social media. And that's been the specialty of another company. Ma Huateng, CEO of Tencent, has been making a success of that for over 15 years. Tencent owns the popular internet chat software QQ for use on PCs and the even more popular Wechat service for mobile telephones. Tencent's total profits were 5.6 billion RMB in the third quarter of this year, respectively close to Alibaba's 6.8 billion. All of this year, the two companies have done nothing but ramp up their competition in online payments, taxi apps, and mobile e-commerce. China now has 632 million internet users, and that means both Alibaba and Tencent each has 632 million potential customers. It's hard to say just how far Tencent wants to push its competition with Alibaba in the e-commerce market, but the fact is that the company bought 15% of internet retail giant JD.com in March. Tencent, of course, is not competing with Alibaba all alone. It has teamed up with a third major player, internet search engine Baidu. And they in turn have joined with China's biggest commercial land developer, Dalian Wanda Group, to form a 5 billion yuan e-commerce group. Why is a property developer getting involved in the internet battles? Zhang Binbin believes it has to.
The debt ratio of Wanda is pretty high, and that's why its Hong Kong listing has been postponed again and again. Because the company has an extremely high debt ratio, it has to set up a story about e-commerce to balance its another very heavy foot, commercial property.
Everyone in the deal has his own agenda. Wanda has offline shops, while Tencent and Baidu have online resources. What could that mean? More opportunities in yet another of China's booming internet sectors, online and offline combinations of sales. Timothy Pope, ICS for CCTV, Shanghai.